Jeremy Siegel, the professor of finance at the Wharton School, is back with us. It's good to see you again, Professor. Welcome back to Halftime.
Happy to be here, Scott.
I was going to get your broad view at the top on what you think now that the Fed has spoken. But before I do that, I want you to react to this commentary from Marko Kolanovic that the correction in bubble sectors is now likely finished. A time of big risks is the headline, but even bigger market opportunities. Do you agree?
I like the overall market in long run. I don't know. I have to say I'm skeptical on whether the bubble stocks have hit their bottom. And I'll tell you why, and it does have to do with the Fed. As you know, Scott, because I've been on with you, I was saying for over a year that the Fed had to be far more aggressive than people thought. And in my opinion, they're still not aggressive enough, given the worsening inflation. What I see this year is a struggle. I think profits are going to be good, but I think that the Fed is going to have some half-point hikes, maybe quite a few along the way. So we're not going to, just, end up at 1.9%. In my opinion, it does not make sense when they say the long-term interest rate 2.4%. Now, they did lower it 10 basis points. That would be 2% inflation with normal employment. Now, even Powell admitted it's the hottest job market in decades, if ever. We know it is the worst inflation in 40 years. And so he's only going to go to 1.9%, not even the normal. You've got to go over the normal in order to slow down a super hot economy with too great inflation. So there's going to be some more upside surprises on interest rates, but there's still going to be good profits. That means that rotation that was spoken about, value growth, really, I think is going to continue through 2022.
Professor, they were. Let's not kid ourselves, right? They were hawkish yesterday. They were aggressive yesterday, right? 7 hikes this year, 6 more. Maybe you get a 50. Then you tell me why I look at the yields right now on my fact set, and I've got the 2-year and the 10-year falling.
Yeah, you have the 2-year and the 10-year falling because it kind of came out as expected. By the way, one thing that was only hinted on by Powell, which I think is going to be a big thing, is he said we're formulating our quantitative tightening rules. And he said it's going to be more aggressive than what we have in 2018. Now, I began to think about that. Their balance sheet's $9 trillion. To get down to pre-COVID was $4 trillion. I don't think they're certainly not going to do it all the way, but that means they're going to be selling $100 to $200 billion of government debt, mortgage-backed securities into the market. That's going to impact those long-term rates and those 5-year, 2-year rates.